Good morning, Bitcoiners. Hello, and welcome back to another edition of your Bitcoin Economic Calendar. I'm Mauricio Di Bartolomeo, co-founder of Ledin, and as with every Tuesday morning, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is Tuesday, December the 14th, and we have a very special episode for you today, as always. In today's issue, we're going to start by talking about what we can expect from this week's FOMC meeting. All eyes are on the Fed and how that could impact markets. We're going to dive into that. We're also going to look at equity markets, which have been soaring alongside inflation. We're going to see if that trend could continue into the near term and how the Fed actions could impact equity markets. And last but certainly not least, we're going to be diving into Bitcoin's recent price volatility and see what some of the underlying indicators are showing us there. So grab your coffee. It's going to be a great one. So starting as we usually do with Bitcoin, we see that it's been a volatile December, and it looks as though volatility will continue until at least early January when more investors return back to their desks. Last week, Bitcoin managed to close the week 1.34% higher at 50,124, above that very important $50,000 psychological mark. However, it has come under pressure again this week, or so far this week, Monday and Tuesday morning, and it's recently retraced down to the 46,858 levels where it is trading now. Diving into Bitcoin's recent price volatility, we can see that if we look at the realized volatilities here, I'm just going to pop this out here on Skew. And what we want to show here is the realized volatility for Bitcoin in the last 10 days and in the last 1 month. So basically the 1 month volatility and the 10-day volatility. I'm just going to pop it up here in a second. And here it is. This chart here, and I'm just going to highlight out the 1 month and the 10-day volatility. And we can see that here, the 10-day realized volatility has spiked from basically 52%. They were both at 52% early in November, to the 10-day volatility has spiked to 88% right now. And the 1 month volatility is currently sitting at 74%. So those are really big changes, as you can see, over the last, say, month or so. The 10-day volatility has gone from 52 to 88, and the 1 month has gone from 52 to 74. So we are seeing definitely these volatile holidays are living up to what many expected them to be. It may continue to be the case as liquidity again is rather thin when people are focused on the holidays. So again, a market event that will most likely accentuate the current volatility will be this week's FOMC meeting, which is being held by the Fed, and we will be breaking this down in more details in our following section. But we have started to see, we've seen Bitcoin prices react to macro indicators as of late, and that we're going to show an example of that right here. And the chart you have on your screen right now compares how both Bitcoin and the US dollar index reacted to the November inflation announcement last Friday. The price action on both is akin to the type of reaction that you see when enough algorithms are programmed to place trades on respective assets based on news headlines. So again, we saw a steep increase in the price of Bitcoin when the announcement came out, and a sharp sell-off on the dollar. Those have since reverted case, but it just makes the point or shows or highlights that there are already algorithms trading these assets based on news flow. Looking beyond this week's Fed announcement and further ahead into the year, there was an interesting projection from the Bloomberg ETF team last week around Bitcoin and crypto that we thought would be interesting to share. In their view, digital assets will usher phase 5 of ETFs. I'm just going to pop the screen here so you can see what I'm talking about. And as per Eric Balchunas, the Bloomberg ETF analyst, there are over 78 digital asset ETFs worldwide at the moment, and there are 42 new pending applications in the US alone. This is how exponentially the number of crypto funds has grown right now. Those 78 funds currently hold $66 billion worth of assets. And the Bloomberg ETF team projects that this number will reach $1 trillion worth of assets in the next 10 years. That is an increase of over 10x for the next 10 years. And this shows kind of what the breakdown is between assets. And the current breakdown is skewed heavily towards Bitcoin and Ethereum. This trend is likely to continue until there is more regulatory clarity around additional assets that will allow them to list into ETF structures. So more on what we can expect on Bitcoin in our What's Ahead section. Moving into the S&P 500, we see that December has continued to be a volatile month so far, with the S&P 500s it roared back essentially to its all-time highs, or the fresh all-time high last week after it had 2 weeks of declines. The market closed at the session's high on Friday, which typically is a sign of continued momentum into Monday. But this was not the case. We've seen equity markets sell off both Monday and Tuesday as we get into the FOMC meeting. And not only that, but there was a few confirmed Omicron variant cases in the US that broke on Monday. And essentially, the nervousness about FOMC meeting and the confirmed Omicron cases helped essentially markets sell off. Now, the risk-off mood that the market has recently taken is perhaps best exemplified by the price action that we saw in GameStop. And this, we've seen it drop quite precipitously. It's down 12% so far this week. And this, while the new variant might be in the media, investors may be more concerned about the actual gap between inflation and interest rates. And that is a gap that we wanted to highlight here. This was actually shared or pointed out by Lynn Alden last week in a tweet. And the gap between the real inflation rate in the US and the federal funds effective rate, so the interest rate that the Fed charges, has never been higher, the difference between the two. And this gap will likely be closed by the Fed raising the funding rate in an effort to bring down inflation. We can see this play out in the structure of the US Treasury yield curve. And this is an example we wanted to highlight. We can see from the graph on your screen that the curve has gotten much steeper over the last 6 months, with the yields in the 2-year note going from just a few basis points to the current 1%. This yield curve structure can be further impacted by this Wednesday's press conference that is being held to announce what was discussed in the meeting. Now, outside of the US, there's also uncertainty and volatility in debt markets. Last week, Evergrande, and this is a name that we've covered here in the past, but hasn't been in the news too recently, we heard that basically Evergrande formally defaulted on its debt. Their bond prices stumbled and their stock was also hit. However, investor concerns are not stopping at Evergrande. Many headlines that came out last week point to the fact that many investors are starting to look at Chinese positions with caution. The MSCI China Stock Index is down 20% year to date and trading very close to the lows. This is the one we're going to show here. So as you can see, it's trading very close to the lows, and it's down significantly from where it started the year. Recent news, as we said, point to foreign investors starting to cut back on their Chinese exposure, which could create contagion in broader Chinese markets. Investors will likely continue to tread carefully this week until Wednesday's press conference by Jerome Powell, and if the Fed decides to accelerate their tapering, we may be in for a red holiday season in the markets. Moving over to gold, we see that gold finished last week essentially flat, down 2 basis points at $1,782 per ounce, even though the U.S. Treasury yields rose considerably last week. So did the benchmark inflation rate, which was news all over the media, and that reached 6.8%, which drove the real returns of U.S. Treasury bonds lower because inflation rose by more than the return of the yields. Now, while this type of dynamic of the real returns of the U.S. Treasury bonds becoming lower tends to work out in gold's favor, the recent rally and the strength of the U.S. dollar has basically negated all of those effects, because for as much as gold has a positive tailwind when the real returns of the U.S. Treasury bonds go lower, it also it gets a tailwind on that side, but it gets a headwind as the dollar has rallied so much. That just puts pressure on a lot of commodities which are priced in dollars. Moreover, macro investors may be unwilling to enter into a gold position in the current macro backdrop. If the Fed potentially accelerates their tapering plans and tries to get ahead of inflation, gold stands to be out of favor until that tide turns. So that could be guiding some of that decision. Moving over to DeFi, we see that the DeFi index and Ethereum both finished last week lower and have been under pressure so far this week. Price-wise, the DeFi index ended the week or last week down 4.94%. This week, it's actually already down again 10.29%. Ethereum finished last week down 1.49%. It is down so far this week 9%. Now, there were a few events last week that highlighted some interesting dichotomies within DeFi. It all started when Amazon Web Services reported issues with its US East 3 servers. These are servers that are mostly used by internet companies to service clients within the Northeast United States. And this is the article that we are making reference to. Ironically, Amazon going down impacted more than one decentralized protocol. One of them was the very popular DYDX protocol. This is interesting for a few reasons. For one, a decentralized protocol should not rely on a third-party centralized web hosting service provider. And second, DYDX is a derivatives exchange that does not conduct KYC. It is theoretically banned from serving US clients. Why would its servers be in a facility set out to service US clients? It's a great question. And lastly, it would not be a week in crypto without an NFT headline. And this week's NFT headline comes to you courtesy of Nike. And that is because Nike just purchased an NFT shoe designer company to build shoes in the metaverse. Brands continue to bet on the space, and it started out with art and entertainment companies, but we seem to be moving into fashion and other industries. Moving over to our Bitcoin mining difficulty commentary, the most recent difficulty adjustment from last Friday brought difficulty up by 8.93% to 24.7 terahashes, just inches away from the previous all-time high of 25 terahashes. We can now safely say that the Bitcoin hash rate migration from China has been effectively replaced as far as hash power goes. The mean hash rate for Bitcoin, which is the actual graph you have on your screen, broke its all-time high last week, which is a very healthy sign for the network. And checking in on the mempool, we see that the mempool still remains pretty quiet. Transaction times and costs remain at optimal levels. And as always, we wrap up with what's ahead for the week. All eyes this week will be on the Fed, who is holding its FOMC meeting. Everyone wants to know what the Fed plans to do or not do about inflation. The US unemployment rate dropped to 4.2% last week from 4.6%. It is now very close to its pre-pandemic levels of 3.8%, and given the structural changes that the pandemic has introduced, we may very well be at the new natural rate of unemployment for the United States. Now, the Fed's mandate is to foster an environment for full employment and to meet its inflation targets. It has already hit one of its targets, unemployment, and now it can squarely focus on its other target, inflation. Poetically, as the Fed is looking to let interest rates rise, the US government just signed a bill to extend the debt ceiling so that it can borrow more money from its central bank. This highlights just how hard it will be for the Fed to keep rates high. The US government's debt is at record levels, and personal debt is also a quite important component of the US economy. Raising rates will put a lot of pressure on the government's bottom line and everyone else's mortgage. So as always, we wrap up with a summary of the upcoming economic events and relevant earnings that you can expect this week. And as we mentioned, no surprise, the biggest one this week will be the Fed meeting. That meeting starts on Tuesday. However, the press conference is not held until Wednesday. So those will be the two biggest events during the week. One is the FOMC meeting announcement, which is at 2 p.m. on Wednesday, and at 2:30 p.m., the press conference by Jerome Powell. A decision to accelerate the tapering process here could certainly introduce volatility in the markets. Also on Wednesday at 8:30 a.m. Eastern, we get U.S. retail sales for November. The interesting note here is that retail sales are expected to show a 0.8 growth versus last month's 1.7% growth. While it's not useful to extrapolate just one report, it will be very interesting to see if this trend continues. On Thursday, we get a look at the labor market, which is initial and continuous jobless claims. Now, while employment data is closely followed by the Fed, given how close they are to their target and how far away they are from their inflation target, it is likely that inflation will be the driving force behind the Fed's decision-making in the near term. So it's a big week coming up. We'll keep you posted right here through the economic calendar. and through our social media. If you enjoyed today's show, if you learned something, we welcome you to like it, share it with your friends, and subscribe to our channel. If you don't yet have a Ledn account, I welcome you to check us out and learn how you can start earning up to 9.5% APY on your USDC and up to 6.25% on your first half of Bitcoin. We also have the best rates for Bitcoin-backed loans if you need liquidity and don't want to sell your stack. Thank you, everybody. Have a wonderful week and see you next time.